go ahead and just get this show started. What's up, everybody? Welcome to the Cash Flow Empire, where we like to bring a lot of individuals. And by now, you may have seen some of these individuals are more on the motivational side, inspirational. Others, are kind of mixing to focusing on multifamily. And what we like to do is just bring amazing individuals so we can all collaborate, learn, and just bring a lot more value to the community. I mean, I think we can all agree that sometimes we don't get a lot of the information we need from our mentorships, and I say that because I am one of those. I am one of those individuals that paid $40,000 and I'm like, crap, I need more information. I need more. So this is why we do this every Tuesday at 7 p.m. Central, guys. And today our special guest is McCartney Taylor. Man, what's up? How are you, brother?
I'm good. Thank you very much. I've got a
Nice.
good slide deck today for you.
Nice. And just really quick, for those of you or for those that don't know who McCartney is, do you mind just giving us unless it's on the slide, then you're more than welcome
I
to
can tell you, either way. I'm a data scientist. I work in oil and gas geospatial data with Blackbeard Data, but I'm also a passive investor in multifamily. So I have an understanding of both realms of how data is, and I also understand what we're looking for to understand conditions that would be conducive to investing in multifamily.
nice. And I think guys, you heard that the man himself is also a limited partner. So I'm sure you do a lot of research since you are a data analyst before you invest in any type of deal, correct?
I do, and I've got to be thorough about it. I'm not just a data analyst. I got 2 degrees in engineering, and I'm a geospatial analysis.
Man, I think next time I'm gonna follow you. You know how they say, location. I think now I'm just gonna be like, you know what? If McCartney's investing in it, then I am too, because I know you did your homework. So,
That's not a bad time, not a bad plan. Sometimes we've done that when investing with some other guys.
nice, brother. Nice. Well, hey man, the stage is yours. If I'm not mistaken, I think you're the first individual who's brought a slideshow. So I'm excited. Like I said, everybody, like we're mixing it up. We want to just kind of dabble a little bit into everything. We have more excited speakers coming in the near future, like McCartney. So keep coming and stick around. So McCartney, if you want to go ahead and get started, man, we'll love. I'm excited.
All right. So can you see the first slide, the state of the economy?
Let me see. I cannot see anything, guys. If you want to, Helen, can you see?
No, no,
Let's see.
they stop the share screen if you could please.
Multiple participants. I don't want to. I think you got to share your screen.
Share my screen again. Okay.
Mhm.
There we go. That should work. Share
There we go. Now we're talking.
Yes.
F5. Now, can you see the whole thing now?
Yes,
Yes.
sir.
Yes.
All right. So this was updated as of today, the 25th of July, 2023. We are going to cover some things. Again, who I am, what I do. I'm a data scientist, CEO of a geospatial data company, and I have been a passive multifamily investor. I've got a couple degrees in engineering, but predominantly I'm a data scientist. There's a QR code on the screen if you want to get a copy of this slide deck. It's available through my website just because I've learned over the few years people like to see and get the data themselves and bring it in-house and look at it. What we're going to cover today, we're going to show what the state of the economy is, but I always like to tell people to understand the measurements of the economy and how to explain at parties the state of the economy to other people. You need to understand what's going on. It's not complicated. There's some very basic things about it. What we're going to cover on the economy is first, what is a recession? And that's an easy question. A recession is when the country's GDP, gross national product, when the GDP shrinks 2 quarters in a row. That is the widely held understanding of a recession. We're also going to cover leading indicators. What's a leading indicator? It's something that happens that warns you that something is about to happen different. Simple economic analysis, we'll cover that as we go, and the potential effects on real estate. So we're going to look at the economy through the lens of a real estate sponsor or a real estate investor or both. Now, on leading indicators, the number one that people should kind of focus on is the yield curve. And what we're looking about on it when it inverts. And by inversion, it means it goes below zero. I'll explain what yield curve is in a moment.
Quick question, McCartney, for anybody that maybe is curious or wants to ask you something. Do you want to save all questions to the very end? Do you want them to raise your hand?
We've learned that we should probably get through the whole presentation, and then we'll have time to go back, pull up the slides that they had a question on, and answer that question at that time. Because over the years, we figured out it's just better to go through it, and that's the best path.
Awesome, guys. Well, you heard it. You heard it from the man himself. If y'all have any questions on any slide, please jot down some notes and write your question down, maybe even the slide, and we'll answer it all at the very end. We'll let McCartney go through his slides and just let him get down.
Yep.
All right, man. Thank you so much. Go ahead.
And I have some auxiliary slides that are often become a second presentation when people have a lot of questions. All right, so on the leading indicators, yield curve is really important. New housing starts is important. Commercial debt delinquency, that's important. Commercial debt meaning loans that people took out to buy commercial properties, office, multifamily, retail, lodging. And the unemployment rate. Now, first things first, let's talk about the yield curve. What the heck is the yield curve? Well, the yield curve is the yield or the interest paid on a 10-year government bond minus a 3-month government bond, also called a T-bill. Now, the yield curve sometimes uses a 10-year treasury minus a 2-year treasury or a 10-year treasury minus a 3-month treasury. But you should expect to get paid more interest if you lock up your money for a longer period of time. So the 10-year period should always be higher than the shorter 2-year or 3-month period. When it is not, bad things are coming. If you look at this graph, this is from 1982 to 2023. When the yield curve goes negative, or when short-term interest gets above long-term interest, that's a sign that the banking industry or the treasury market is expecting bad things about to happen. So we have learned over the last, since the 60s, so we've learned over the last 80 years that when the yield curve inverts, a recession will happen usually within 22 months. And every recession has its own flavor, right? Something different caused it predominantly. The fundamentals almost always cause a recession, but sometimes it's inspired by something different. The great financial crisis of 2008 was about the credit markets and lending to residential and commercial buildings. So that was a credit-based recession. The 2000 boom bomb recession was an overinflated asset valuation recession. And then you can go back to the Gulf War inspired recession, 1991, 1990, and then you've got the interest rate and inflationary effects that caused the 81 recession. So each recession has its own flavor. If you notice on the graph here, the yield curve is extraordinarily inverted. It's way down there. So we've never had one this bad. And if you look at the graph, you'll notice the recession starts after the yield curve uninverts. And fortunately, we're not there yet, but we're going to get uninverted probably in the next 3 months. But this is not a good sign. So we're inverted, not good. New housing starts. This is found to be an indicator of the end of the boom of the cycle. So when the housing start peaks out and it slides down, you know you're headed for potentially recession. It's not as good at timing them as the inverted yield curve. But you'll notice the great financial crisis, your housing peaked around 2006, and 2 years later we have the crisis. 85, it peaks probably around 86, and then there was that nasty bit of oil crashing in 87 that caused Texas a lot of grief. But you'll see that right now we've peaked for our housing starts. There is a little spike that has just happened in the last few days before I updated. So that spike has left me to where I'd like to see that updated for a few more months before I'm fairly confident that the housing market, new housing starts has peaked. And now let's talk about the Fed funds rate. Sergio, can you tell me a little bit about the audience? Are these predominantly people who are going to be deal sponsors or investors?
So we have a mixture of everybody. A lot of these individuals are brand new to multi. This is why this is such and I'll talk about it later. It's an important call. But a lot of people are kind of coming in as limited partners. A lot of them are trying to become general partners. A lot are here to get educated a little bit more about multifamily real estate in general. So we have literally a pool of everybody in here.
All right. It's good to know my audience. And I like hearing that there's going to be a lot of new people who want to just learn about the market and about multifamily before they really pony up the money on the table.
Correct.
It's a great industry for investing. It helps when you understand the important concepts of the Fed funds rate and the return on a cash flowing business. So here's a basic concept for everybody. The old folks already know it. The veterans know it. When the interest rates rise, that means bonds rise. Bonds are considered to be fairly risk-free investments. Money flows from riskier investments to riskless investments when interest rates rise, which means that assets that are cash flowing, like multifamily, they get appraised for a lower amount. So when interest rates rise, that means the cap rates rise, your valuation of your multifamily property drops. Even if your multifamily property has the same NOI as last year and the same NOI as the year before, makes the same amount of money the whole time, if interest rates go up, the overall valuation of your multifamily deal goes down. When interest rates compress, meaning they go down, the value of your multifamily properties goes up. It is an inverse relationship, and it's because of discounted cash flow analysis. Multifamily is appraised based upon its cash flow, and that's compared against the risk-free rate. When the risk-free rate goes up, the value goes down. So on this graph in front of you, where you really wish you had been investing is on the falling side of the cap rate. And where you want to exit is before the rising side of the cap rate. Where you would love to invest is at the top of the plateau. So crazy things happened back if you could invest as it was falling. You're getting that benefit of all that cap rate compression. Now, 2008 was a different beast, a different recession. That was based upon real estate and credit markets. So there was some issues on valuations in 2008, but generally, as your cap rate compresses, your valuation goes up. I want to buy properties as soon as we hit this plateau up here. And then those properties are going to have great yields. Down here at this flat period, let's see, I was investing in deals during this flat period, and we were getting upper teens, lower 20s ROIs, return on investment, internal rate of return. And as the rates go up, our returns start to drop to the low teens. If you were ever able to buy at the peak, as the rates compress, you were getting 20s and 30% returns on your investment. That's annualized. So you should pay attention. The one takeaway you get out of this whole talk is to understand the Fed fund rate affects your investment in real estate. If the rates go up, your investment value goes down. So where are we right now? We have had hikes and hikes and hikes for the last year. We have another hike that's going to happen tomorrow. The percent odds of it happening right now are 98.9% chance. That's pretty much a done deal. There is a 40% chance there will be another hike between tomorrow and November 30th. So we have probably one more hike coming, maybe two. There's like a 5% chance of two. After that, I was talking with Helen about this. By March, you're at 50-50 whether or not we are done with the hikes. So that's about the time you really want to be investing, is by March. All right, so that's an important thing. The narrative here is that we are raising rates to stop inflation. The Fed has two mandates. One is to maintain our inflation rate below 2%. We must raise rates to push down inflation. The effect is to knock out jobs. If the economy is too strong, there's too many jobs, and there's inflation. You raise rates, you push down jobs, it lowers it. So we've got jobs are going to go away. Unemployment will rise, already is. On to the next item, not as important. Unemployment. Now, people who really know unemployment ask, well, which unemployment number? This is U3. If you have no idea what U3 is, it's okay. It's just unemployment number. We've got two lines here on the graph. We've got the red one, which is delinquency, and we have the blue one, which is unemployment rate. You will notice in 2008, the delinquency rate on commercial real estate, that is offices, retail, lodging, and multifamily. They bundle them all together. The default rate went up there and touched around 8.5% during the Great Financial Crisis. When you were here in 2007 and begun to saw this go up, that was a warning sign. At the early days of 2008, when you see the delinquency rate going up, that's another warning sign. That tells you something bad's coming. The upper one is unemployment, and our unemployment is nice and low right now. The delinquency rate on this graph, and this graph is coming from Fred, that logo on the top left. I want everyone to remember the word Fred. Fred is your friend. It's the Federal Reserve's database. It shows data, displays data, has data visualization made extremely easy. It's a no-brainer. You can tell it to export it as a PDF or as a JPEG and stick it on your presentations. So it does a beautiful job. No one here has any excuse to not go look up Fred to see where we are on the inverted yield curve or on unemployment or on delinquency rate. But we're going to come back to delinquency rate in a moment because we want to separate out office from multifamily and lodging and such. So you will notice before we go that delinquency rate kept going up after the great financial crisis had hit. People are loath to give up on the real estate they have bought. They're going to hold on as long as possible. So that's why there's a lag event from the peak of the delinquency. So at this point, the takeaway for the narrative is delinquency rate doesn't look bad right now. And I like that for real estate. That looks good to me. So I went to another data source that breaks it out, the delinquency rate based upon each individual sector. And for your interest, office delinquency rate has now gone up to 4.5%. And this is updated since a few weeks ago. So office rate shouldn't be that high. They're in for a world of hurt. It is coming and it's going to get worse. And if you're thinking about being a deal sponsor on office, I would caution you. The multifamily actually fell down to 1.46. That's just bottom floor noise. Multifamily delinquency at 1.46, that's nothing. I wouldn't be worried really until that breaks 2.5. And even at 2.5, I'm just concerned but not worried. Lodging spiked up pretty bad because of COVID. We're going to ignore lodging. We don't care about industrial for this talk, and we don't care about retail at this point. But lodging and retail took a pounding during COVID. We care about multifamily, and it's going down, so it's healthy right now. This is the New York Fed's recession forecast based upon a yield curve model, and we all know about the yield curve. So this was updated as of June 2024. It is right now at 67% or 2/3 chance that there will be a recession that will begin within 12 months. So that's what this means. It's a 12-month forecast. We most certainly are going to probably have a recession. It could take 24 months, but this has got a 2 out of 3 chance it's going to happen within 12 months. And this should be on people's radar. Bad things are coming. There's probably going to be a recession. And I'll talk about a soft landing. How many people out there have heard about soft landings? You can raise your hands. So soft landing is economist speak for raising interest rates just enough to slow the economy down, but not take it into an official recession of 2 quarters of lower GDP growth. Soft landing is slowing it to where inflation's under 2% and a recession doesn't happen. And there's talk about that. But I'm here to tell you that's going to be bullshit. It's going to be a recession. I don't think we can get out of this one. So on to the next one. The current narrative we're hearing is we have a pretty badly inverted yield curve. We've got rising Fed fund rates. Housing starts look like they have peaked out. The Fed itself is forecasting a 67% chance of a recession within 12 months. And I think it's going to happen. I also see that the rising Fed funds rates has not dropped job growth, which is scaring the Fed. I think what they're going to do is they're going to raise tomorrow and probably again. And I wouldn't be shocked if they raised it a 3rd time, trying to get the inflation down. Headline inflation is at 3%. Core inflation is at 5.1. Core inflation is what matters, and it's really still high. So if they don't hike up more, inflation keeps raging and erodes everybody's money in this room. right? Your money from 2 years ago, whatever you had in the bank is now worth 10% less because of 2 years of inflation, which is why we want to put our money into hard assets like multifamily, things that are inflation resistant. So our analysis is we expect one, the cap rates are probably close to capping out, 1, 2, maybe 3 more hikes. We want to be invested in the next 6 months if we can, and we're more than happy to be investing when the cap rates begin to compress. There is probably going to be a recession, so be wary of that, especially if your job is dependent upon an industry that is iffy. And now we're going to talk about mapping. So the bonus on this is I'm going to show the US, and I have used geospatial analysis to make maps of the whole country of where job growth is shrinking. So this is using unemployment as a proxy for population change. Now, Texas has been taking a lot of growth in 2020, 2021, 2022 a little bit. And now you're looking at a map where green is good and brown and red is bad. And this is showing that inflation has changed for the worst in Texas in the last 3 months. This is current data. And this does not jive with all the wonderful things you've heard in conferences and seminars about how Texas is growing. Population will follow jobs. DFW has slowed down its growth and it is now losing jobs. Unemployment's going up, and that means people will probably stop moving there at the speed they used to. Again, we're using proxy of unemployment as an indicator of population change. So Texas, Austin is the reddest. So this is where we're losing the most jobs. They are going away. We've got DFW that has lost jobs. Odessa and Midland have green. They are definitely still growing. I've pulled up their census data, estimated growth, and it corroborates this. But we are all smart investors. We are going to learn, if we haven't already learned, to never invest in multifamily real estate in a mono-economy area. We do not want to be hitched to a single industry or you're going to get bit hard. You do not want to go invest in Midland, Odessa, because that's oil industry. When oil goes down, and it does, I'm a petroleum engineer, I can tell you, everything goes down. All your multifamily goes away. I had a friend who invested in 3 hotels in North Dakota that was catering to pretty much one industry, the oil patch, the shale play up in North Dakota. When shale went through the floor, he lost all his investment in those 3 hotels. Gone. $750,000. Poof. So we're going to be careful where we want to invest. So this map, we're going to show you good areas and bad areas, but also bear in mind there's other filters to apply. Look down here, you've got Corpus Christi, you've got Houston, you've got Beaumont, Port Arthur. Beaumont and Port Arthur are fairly mono-economy. They are on refining. 2, they're on the coast. Do not invest within 20, 30, 40 miles of the coast. Hurricanes will go through there and can trash your investment. Yeah, you're only going to be invested in 5 years. The odds are you're not going to get hit, but that's a mitigatable risk. So please mitigate it. You can get insurance, but insurance doesn't insure for everything. Flood damage is not insured by hurricane insurance. Hurricane insurance doesn't cover things like wind damage. It's weird. So insurance won't cover you and make you whole. So if you can avoid the coastal areas. Let's go to the next area. You've seen Arkansas is green. Little Rock and Pine Bluff, Fayetteville, Fort Smith, they're growing jobs in the last 12 months. And that's what this is 12-month delta between 12 months ago and today. They are growing jobs and unemployment's going down. Mississippi, Gulfport, Biloxi, again, it's green. I'd never invest there. West Coast. Oh, look, California's red. Unemployment is coming to California. It's pretty bad already. Oregon, the western part is the industrialized areas. It's a mixed bag. Washington is a mixed bag. Montana, interesting. I don't think those are large population bases though. Idaho is green. Utah's mixed. Colorado, that's interesting. I'd pay attention to that. New Mexico, I'd pay attention to that. But we're going to be wise about looking at this map. This is using unemployment as a proxy. If you look down, I don't even know if you can see my mouse, and the very southern tip of California is El Centro, California. That particular area has been blighted with unemployment for half a century. It just does not have a good low unemployment number. And so it's gone maybe from 20% unemployment to 22. That's pretty bad. Dallas has gone from, I think 12.8 to like 13.2 or something. It's not too bad at all. So each area is, if this is a delta of unemployment from the past to the current, and even if Dallas's unemployment is lower than Santa Fe's, because the change is showing us it's losing jobs, we're implying that the population will change. But bear in mind, we're using unemployment. There's some gotchas to observe with that. Let's move to the East Coast a little bit. New York is an interesting case. Since 2020, New York, I think, has had the largest population outflow of all the states. But for the last 12 months, the unemployment is dropping. So that tells us something interesting has happened. Something has equalized, and they're now gaining back jobs. Look at Mississippi as well. They are green. That's interesting as well. Illinois is still green. They're still gaining jobs. These are not high-tech jobs. These are white-collar, but not techie jobs. Georgia is losing jobs. And Florida is still green, but kind of. Let's look at Florida a little closer. Miami is green. They are still gaining jobs. There's probably a good sociologist out there that will explain why it is. I couldn't tell you. I'm just telling you unemployment is dropping in Florida. Now, this is the end of the formal presentation. I have more slides. As a quick note, my wife told me I could build a shed in the backyard. 2 years later, that's the shed I built. I think every shed should have gargoyles, right? All stone masonry, beautiful arch ceiling. Anyway, now is the time I'd like to open this up for questions. And I can also go over some interesting things about office space as well. Sergio, you want to drive the bus here?
Yeah, guys. I think before we have Jonathan, the MF investor, come on and answer some of these questions. Ask a question. This is extremely valuable, and I'm actually excited to go back and look at this on the recording, guys. Now, if really quick, y'all show McCartney some love real quick. If you've learned at least a little something, put some fire on the chat, guys, because this is amazing. This is information that when you're able to hear everybody sit there and say like, oh yeah, well, you know what, there's the market sucks, or there's a recession coming, when do I invest? This is where you bring this valuable information. you go back, you can watch this video and you can explain to them, well, listen, we're at a curb right now. This is actually the perfect time, or this is not the perfect time. We're at, we're actually going up, based on everything we just learned on, in 20 minutes, 20, 30 minutes. Super, super valuable, man. I thank you so much. Let's get some questions. I think everybody's going crazy in the chat. And then we also have Jonathan, the multifamily investor, brother. Come on, step on stage.
Awesome. I just unmuted. Can you hear me?
I can hear you.
Everything good.
Awesome. Hey man, so yeah, we've got a property along the Gulf Coast, and it's 4 different properties down there, and it's not too far from the Gulf itself. So when you said you wouldn't invest around there, that was a little scary. They total 302 units, and we're trying to buy them all, same seller, 4 different properties. And some of the quotes we got were a little bit high, and but if the property's been standing 50 years, what are my risks as far as investing in that? I mean, what are my risks? Like, why would you stay away from a good deal though?
I want to mitigate mitigatable risks. So I'm trying to avoid risks that I know I can simply not get involved there.
Yeah.
The danger is if it's such a good deal that you're tempted to take that risk, as long as you're aware that a hurricane can come during the window that you're investing and absolutely wreck that property, which has happened in our group, in Ken's group in Austin. I forget which hurricane it was in the last 5 years, but he had some properties down in South Texas, and he had insurance. And there's also something about, there's an insurance you can buy, which is the vacancy, involuntary vacancy insurance, something like that, where they'll pay you for 12 months because you have no tenants because of a natural disaster. That only goes for 12 months. And it takes longer than 12 months to fix a lot of these properties. So he was in a world of hurt because he only had standard hurricane insurance, which didn't cover some of his flooding damage, and it didn't even cover a lot of the remediation that was required. So they got hurt. And so that's a lesson that I think everybody should learn. You should always learn from other people's mistakes. Should it scare you a little bit? Yes. Should you not buy? That's up to you and your stomach for risk. And if you are going to do it, pay extra attention. And when you're underwriting it, put in the extra numbers for extra layers of insurance, because you're trying to mitigate down that risk. And you'll notice that the deal does not become as good a deal as it looked like, because it can't be underwritten the same way as a landlocked property.
Yeah.
It has extra risk.
Yeah, there's definitely some risk there. And we're like just on the border of the flood zone. And one thing that we do have but locals that live there said the only time was Katrina is the only time we ever had to worry about floods in this area. Because, it's 23 feet higher than the coast, but that's the insurance trying to make a case for me to pay them, $400,000 a year as opposed to, $200,000 a year. So that's them talking the flood zone. But so we've got a good crew that can come out there and redo a roof. Like one of my partners, he bought a 64,000 square foot warehouse, and the seller gave him a $70,000 credit, said it'd take at least a month. The crew came out there, did it in 2 weeks for $17,000. So, I'd rather, take the risk and make fixes instead of paying a monthly insurance on something that hasn't happened. So what would you recommend there? Like, what's your thoughts on that process? We've got good crews come there, do the floors, do the painting, do the roofs, they're
Okay. So past experience has taught me when you have a good crew and if a disaster happens, they have a chance to go make bank, bail out of you, and go do it for other people who pay them more. So when you need your good crew, you may not have your good crew. So factor that in. overall, if you've got a plan to make money on this and you're okay with the risks, then do it. If part of your plan is to actually flip it within a year of stabilizing it, that will reduce your risks as well. So
Yeah.
That always makes me nervous to be anywhere near the coasts, in a flood zone. You've got fairly good insurance for fire. You've got fairly good insurance for tornadoes, but as a deal sponsor, everybody should actually pay attention to the insurance product they're buying for their property. Read through it down to the nth degree so that you don't simply buy insurance because you were told to buy insurance. So you bought insurance that's really crap. You need to look at your insurance and realize your insurance is good, because that's your money there. Your payday is the end of that exit. So that's my advice to you, is make sure you pay attention to the risks, acknowledge the risks, and see if you can mitigate them as best you can if you're determined to do the deal.
Gotcha. Okay, thank you for
Sure. There was another hand up that I think she's.
Yeah, I think it was Melissa. And before we go to Melissa, hey, dude, Jonathan, that was a hell of a question. That was just kind of brought back up the, the thought of a disclaimer, guys. I forgot to do it, but guys, don't forget, all investments are risky. Whatever you come in, it don't matter if it's multifamily real estate. There's always risk in every type of investment, and just don't forget to consult, obviously with your tax professionals. We are not attorneys. I do have an attorney in the group, my cousin Carlos Aguilar the fifth. Consult with him and any of these type of contracts or any other real estate attorney that man. And Jonathan, yeah, for sure. Look into that, how that's structured, bro. Look into that, the insurance. I mean, as they say, I saw this video and it was kind of funny, but it was true. His old guy said, "Hey man, you can't fuck with Mother Nature. You just don't know." Katrina hasn't been around for, what was it, 2005, 2006, but who's to say that next Katrina won't happen in the next couple months?
You're scaring me now.
Nah,
You're scaring me now.
You should be scared a little bit so you recognize your risk.
Yeah, the only thing is, like, on the books, they're saying that they're operating at like a 55 to 60, depending on the property, percent occupancy. It's being mismanaged. They've got 60 to 65% expenses. Like, there's a lot of upside when we get in there and stabilize that thing for us to turn around, break it up, and resell at least one or two to recoup our investments.
Sounds like you're going to have a really good rate of return. So all returns are commensurate to risk. If you accept higher risks, expect to have a much higher return.
Amen. I love it.
Awesome.
Sergio, can I make a mention about this graph that we're looking at right now?
Go ahead. Let's.
Okay, first, I want to have the caveat that I'm a data scientist and I did not make this POS. This is a terrible data visualization. I would not do this to you guys. This came from a different source. They have data I couldn't get to. This breaks out 5 different types of commercial properties: lodging, retail, industrial, office, and multifamily. And this is how bad things got during the great financial crisis. So right now, remember, we're at like 1.5 of delinquency. Things got so bad that multifamily in the great financial crisis was above 16%. So that tells you right now we're healthy. Office space right now is already up to 4.5. And this graph stops around April 2020. So it's an older graph. And at the time, office was fairly low. So office is on the way up. And that's going to be where bad things are going to happen. Lodging and retail, you can tell from COVID, spiked. Bad things happened there. But multifamily is low. It's going to stay low. The recession that's coming isn't going to do the same thing it did in the great financial crisis. That's all I can say on that one. And a little extra note here on the Case-Shiller Home Price Index. Mr. Shiller, by the way, is a Nobel Prize winner. So I give him some credit here. So the Case-Shiller Home Index price just gives you an average price of homes for a region. Blue is the national price of a home. Red is the DFW average price of a home. And I intentionally cut off the y-axis so that you couldn't look at numbers and get distracted. I just want everyone to look at this graph and see that during the great financial crisis, Texas properties were fairly flat. We were fairly unaffected price-wise by the great financial crisis. The rest of the nation took a beating. We did all right. We just did flat, a little dip down, and that mean that we didn't pay as many taxes. But since then, Texas prices have gone and touched the national prices 2022, and they've dipped a little bit. So if we're in an overbought market right now for single family homes, which is what this is about, not multifamily, single families, we're probably with the country on having a bubble. But I'm not going to go down that path right now. I just want everyone to see things have changed. Texas has caught up with the average of the country.
Nice, man. Thanks for the. You got more tables?
Oh, I do, but I'm waiting for some questions.
Yeah, I think Melissa Vasquez had a question. She was one of the ones that raised her hand. Melissa, if you have that question, she said that it was already answered. Okay, well, I wish we knew what it was so that maybe I didn't catch it. Let me see. I think I could have sworn I saw one in the chat. Guys, don't forget, if you have a question about the market or on something that wasn't clear, please raise your hand. It looks like Jimmy Lou is on stage. Brother, what's up? Welcome to the stage.
Hey, Sergio. Hey, McCartney. Thanks for all of this information. So it is very interesting when you're looking at it from the broad perspective, right? And then for investment, what is your list of criteria when it comes to investment?
Ooh, for multifamily, we're talking.
Correct.
I am looking for a deal with an experienced team, has to at least be 2 or more people. I'm looking for a deal in an area that has good population growth. And I'm looking for a deal where the sponsors do not have their fingers in the pie of being the property managers as well. So I'm trying to mitigate that conflict of interest. And I won't name names, but there's some big sponsors that have gotten so big they've become their own property managers, and they can extract value out of the investors through the property management where you don't get a benefit. So I'm looking for deals that I'm expecting somewhere around 8% cash on cash return. And then I'm looking for an overall upper teens, lower 20s probability of return. So that's sort of my criteria right now. Does that answer your question?
Yes. And then does that mean that it already follows? I'm assuming that you already look at all of this data, economic data, and it's right timing, then that's when you start looking at all of this specific criteria on the deal.
What I'm doing in the meantime is I'm finding deal sponsors, I'm vetting deal sponsors, I'm asking them for their past deals, what they look like, how they executed, how well they communicate to their investors. And I'm lining up deal sponsors. So in 6 months, I can start deploying capital. And also as a data scientist, I actually love a good recession. I make a lot of money during recessions because I know how to work the financial industry with the volatility and the downside. So I kind of enjoy the recessions, but I do want to get in on these properties before as the rate cuts come, because you're going to get upper 20s, lower 30s returns. You can make a killing on the downslide, and then you don't want to be greedy up until the the next uptick. So a lot of people that bought properties in the last 2 or 3 years, you're up against that hike, and now people who bought properties that were interest-only financing, you've just backed yourself into a corner with really high rates. And if your bubble's coming due, if your bubble payment's coming due, and you've got a problem refinancing it, you can do a cash call. So I don't want to invest in anybody who has interest-only financing. That's how you get in trouble.
The way he mitigates risk, I love it, man. It's kind of
You gotta have,
interesting.
if you get old enough to have some gray hair, you'll understand about mitigating risk. You can't always bet that things are going to work out the way you think they are supposed to go. And they often go sideways when you don't expect it. So you want to mitigate risk before you buy things. And I think Gabrielle had a question.
Correct, Gabrielle. Hello, Gabrielle.
Hey,
Welcome.
can you hear me?
I can barely see you over the top. There you are.
Oh, okay. Is this better?
Yes.
Okay. Great, a great presentation though. So I really have two questions. With the economy like it is now, would you still expect to have a 8% cash return on a property now? Or are you saying like on the way, like how would that work?
I would prefer, and I think it's still available, it might be down to 7 right now. I've not been trying to buy properties during the hike, obviously, so I'm a little disconnected from where the price is right now. This year's batch of investment deals I've not been paying attention to too close. I would like, though, to see 7-8% cash on cash if possible. And I want the property bought right. And which area are you investing in?
Georgia.
Okay, I don't know the Georgia market. It could be very different than the Austin market.
Okay.
So you might have deals that 4% cash on cash is normal, or you might be in place where 12% cash on cash is normal. I don't know your market.
Okay, I got it. And my other question, when
Yes.
you're new to an area that you're investing, how do you interview the people that you would like to do business with? Like what kind of question do you ask for? And what are your criteria for you to even do business with them?
First, I've got to find out about them. So I would ask a local group, who are the predominant deal sponsors that are successful there? Can you give me some names, emails? Email them saying, hey, I understand you're a deal sponsor. He's probably looking for 506C stuff. So Sergio, I presume this room knows about 506B and 506C.
Correct. But if you want to kind of just describe it a little bit, just so we can.
Okay, so 506C deals are for accredited investors. And there's some flavors in there, but we'll keep it saying they're accredited. They have to be above a certain threshold of wealth, not including their home value. And so when I contact a deal sponsor, you can say, hey, I'm a 506C accredited investor. I'm interested in your deals. Could you send me a copy of your last deal so I can kind of go look at how you structured it? And could you tell me about your future deals? So have them send you their past deal and then talk to you about the current deal. If they do not or hesitate to send you their past deal, you are done. That is a warning red flag. Something is wrong. You do not want to invest with them. And you'll hear that from multiple people. So they should be, but they don't know you also. So you might want to introduce yourself saying, I'm an investor. I'm interested in your property. Do you have some current deals? And, oh, can you send me a copy of your last deal? There's people in this room who belong to one clan or another of the real estate clans, the groups, the Brad Sumrocks, the Lifestyles, the Big Dogs. And each of those has a fairly good understanding of how the industry works. And they will also tell you the same thing, that you should expect to ask a sponsor for their past deal, and they should be able to send it to you. So it's not just me. There's lots of groups that tell you the same thing. Helen, would you agree with that?
That was
That's a
great.
thumbs up.
That was great advice right there. Just vetting your operators and your sponsors. And, you know, there's a lot of deals going around. As I say all the time on these calls, guys, there's a lot of deals going around. Oh, yeah, I got a deal. Come invest with me. Come capital raise with me. But it's just like, wait, you know, who the hell are you? Let's find out more information. You got to start vetting. And McCartney, I'm glad you said that. It's just something that we stress in our community a lot at the Cash Flow Empire. I think just to elaborate a little more, we want to create savvy individuals. We want people to learn and to vet, because we made that me and my partner Jonathan, we made that huge mistake at first. We found whatever opportunity came across our way, and we took a bite at it. And sometimes that's just not the way to do things.
As a deal sponsor or as a investor?
Both. Well, no, sponsor, thank God, not we've by then we've learned, but we're just talking about as investing into deals, investing into individuals, you know.
Then I'd like to say something else about the real estate clan groups. And I just use the word generically. They are a clan of people. So each of these cliques or these groups that can be hundreds of people large, they're all led by generally a competent, possibly charismatic person, but they're led by people who have done it and have hundreds of millions of dollars under their belt of having done deals. So the Brad Sumrocks and the Lifestyles, the Big Dogs, and Cash Flow something or others. And so all those guys are churning out newly minted sponsors. They are training people on how the industry works and teaching them the gotchas and teaching them underwriting, and they're turning them loose. And why I vet deal sponsors based upon if they are or are not associated with the group is important, because what happens if a deal is brought to you and you ask, well, which group are you with? Which clan are you with? You say, I'm with Brad Sumrock, or I'm with Lifestyles. You know, they actually had to go do the work to learn the business, and they have seen how underwriting works. And more importantly, if they're still active with that group, when they have a deal, they'll bring it to their mentors at Lifestyles, and their mentors look at the deal, and the mentors are looking for a gotcha. And what they usually say is, I see no problem with this deal. They won't say I endorse it. They'll simply say, I don't see a problem. And then it might get kicked up to the top tier executive level of that group. And like the Brad Sumrock himself, he'll look at that and say, I see no problem with this deal either. He won't endorse it, but you've got now 3 pair of eyes at 3 different levels independently, looking at the same deal, looking for a gotcha or a bad assumption, and nobody found it. And then it got offered to the investors. And so what that does is it filters out some deals that are crap. It doesn't filter out all the crappy deals. Let me get straight with that. You can still have an occasionally poor deal get through, but the egregiously bad deals don't get through those systems. The clans knock those out. So I'm always wanting to invest with somebody who is part of one of those groups and understands and has a track record as well. So I think, Sergio, that was my extended version, is I like all those groups because they provide extra layers of protection to an investor by getting rid of filtering out the really bad deals. Because there's people out there who think, oh, I can make money in real estate. You can, as a blind monkey throwing a dart. But you can also sign up with Joe, Bob, and Bubba, who did not do this through a group, and they're just trying to do it the other guy does. And they overbought the property, paid too much for it, had assumptions of 6% annual rental growth, and that assumption ain't gonna fly.
Yeah. Yeah.
So
Awesome, man. Awesome answers. I love it. Just so you guys think we're not bullshitting sometimes, you can hear from McCartney. But Helen, you got a question, and then we'll go to Brendan.
Yeah, I just have a quick question. Like, for example, let's just pretend that you are just going to start investing in real estate for your first time ever, but you have all the information that you have right now. How would you start if you have like $50,000, like you have been saving, you got all this knowledge, and now you're going to start? How would you do it?
if I happen to just be 3-4 years out of college, I got 50 grand I've saved up, and I wanted to start investing. If I knew then what I know now, I would be going to my local meetup that has like-minded multifamily investor groups. And those groups are typically for education, just like your group here is, and just like Ken's group is in Austin. And I would sit down and I would just want to learn about it and find out, okay, who's the local people you guys would invest with? And what's the return I'm expecting? How do I become a good investor? And how do I avoid a bad sponsor? And so that's what I would do, is I would join my local group, learn from them, find out who people like, who have done deals with. So I get experienced guy. I may not get the best return because the more experienced they are, they will have a higher promote in the back end sometimes. But I am guaranteed to get a return, almost guaranteed. And I have a much lower risk. And the first time you invest, you don't want to have a dud. So I'm happy to take low teens for a return, right? And I'm going to be in a deal. I don't know if this group believes in the whole 5-year exit plan. I like to invest in a deal and be out in 5 years before the equity builds up and I've got dead equity.
Correct.
Right. So I want to be in a deal and I want to be out of a deal in, if possible, 3 to 6 years. And we had one guy know that, geez, he exited with a 327% return in 3 years. He bought a sweetheart of a deal, had to do a lot of refi on it, not a refi, some rehab work on it, and he smoked it on the way out. But as a new investor, you're not going to get that. You're happy with low teens. I want a 12% return, 15% return. I'm happy with that. If I was 25 and new to the game, or if I was 40 and just getting into the game. So I think that answers it. And does Gabrielle still have a question? Her hand's still up.
I think she left it on accident. She just turned the camera off.
Then it's Brendan's turn.
Brendan.
Thanks, Gabrielle.
Hey, what's going on, McCartney? First, I want to say thanks for the economic analysis, and more importantly, your perspective as an investor. It's the first time that I've heard an accredited investor speak on what they're looking for out of deals and what they look for the people that they partner with on deals. So it's been very good value added. You mentioned something that sparked my attention earlier in your briefing, and that's when you said you particularly don't look for sponsors who've gotten so big to the point where they can be their own property manager, because they have a way of sucking the value out for the investor. And originally I accepted that notion, and then the more I thought about it, the more it kind of perplexed me, because I initially thinking, wouldn't they have more of an incentive for the investment to perform well? So my question is, how or in what way, and from your experience, does that sponsor that's also serving as a project manager kind of suck the value out from underneath the investors?
Okay, so you're going to take the devil's advocate position, say, McCartney, I don't believe you. Tell me why it's bad for a sponsor to also be a project manager.
I'm not taking the devil advocate side,
no, I want
clarification.
Okay, so why do I have the attitude I have towards it? And it wasn't just me who told me about this. I got this one from a guy who was over 80, and he was telling me about it. And the three other old guys around him said, "Oh yeah, that's absolutely true. You do not want the deal sponsor to be the property manager." There's something called conflict of agency. I think that's a legal term, maybe. But basically, it's not being paid in the same coin of the realm. The deal sponsor, their responsibility to their investors to make sure the property is run. And if they turn it over to a property manager who runs it, there's no conflict. They just manage the property manager. And that property manager manages lots of other properties. But if the deal sponsor becomes a property manager, they open up a second business. And now when they go do a make ready, they get to go charge your partnership X amount of dollars to go make that make ready work. When there's a plumbing event, they have their own plumbers that are part of their management team that are not part of your management team, that they're charging your partnership for that plumbing event, and so on and so forth. And they're also changing out tile, they're putting in renovations, and they can charge a premium to the partnership. And over and over and over, if you study cases where you have deal sponsors who also had a property management company, you will find that there is an egregious charge that is charged against the partnership. If he were not a property manager, he'd be fighting to keep the cost of the partnership as low as possible. But instead, he is fighting to get the property repaired and plumbed as cheap as possible for his company, while charging you what's tolerable to the partnership. So there is a conflict of agency there.
Right on. I can get with that. I appreciate it, McCartney.
Can I hear from him saying, yes, I get it?
It does. Do you hear me? Can you hear me?
I can hear you, but I couldn't hear from Brendan. Brandon.
I'm Brendan.
Yeah, Brandon, I can hear you.
All right, cool.
Yeah. So he comprehends.
No, that's good.
Actually, my cousin, who's a real estate attorney, he named it. He said it's called a gray area in fiduciary duty.
Oh, that's a different, yeah.
And he said he had a case on that exact matter last year. So it does happen. It's honestly something I never considered, but maybe I mean, you learn something new, right? Every Tuesday, guys. Now it's something that we might need to take a look at. Ask who the property manager is. Is it they're going to be a third-party property manager, or is the KP/sponsor trying to be the property manager? So, man, that was good, McCartney. I love that you said that. And Brendan, that's a hell of a question.
That was a good question. Actually,
Man,
all of them are good questions.
Yeah. I'm glad. I'm hoping everybody's having a great time. I know I am. We like to do something called breakout rooms, McCartney. I don't know how you are on time. But
I got time.
what we like to do is we usually like to end the recording right now. We'll do like an outro, and then after that, we all get in a breakout room, and we'll probably do an average of about 2 for 5 minutes, and everybody gets to have that one-on-one. Well, whoever gets lucky gets to have that small, intimate conversation with you. So everybody likes to do that, man. And so we'll go ahead and if you're down, we're ready to do that right now. We'll wrap the call up. But that being said, McCartney, man, that was amazing. I think we all learned a lot here. I know I learned a lot. And if you learned a lot, guys, put a like and put some fire, put some claps in the chat, just to really let McCartney know that, you're in here, you were listening, and there was a lot of value added tonight. And it looks like it's going off right now. McCartney, man, thank you so much once again for joining us tonight on the Tuesday night with the Cash Flow Empire.
Good to be here. And everybody remember, the yield curve is important. It tells you what's coming. And to understand the inverse relationship between the cap rate and the value of a property, which is why you want to buy at the top of the Fed hikes.
Awesome. John, if you can end the recording, that would be amazing. It's all right. We'll cut it. We'll cut it short. I know it's he's probably busy, but let me see, guys. Really quick, we'll do some breakout rooms. We'll do some quick breakout rooms so that we can all, get a chance to have some fun with McCartney. So we'll go ahead and do that right now. Assign automatically. Let me see. Awesome. All right, here we go. And Lynn, that was good. Jimmy, Helen, that was really good.
That was really great, right? I really love it.
Good
Gosh, I
job,
know.
Helen. Good job, Helen. She said,
Yeah.
yes, I know. Like, yep. Let me.
No, no. He did the presentation here in Austin, and
Nice.
the room was full. Like even people didn't have any chair, and people have to stand on their feet because the room was full, super full. And when he said, "I'm willing to do this in any of your groups," it's like, yeah, I want it. I want it.
Cool.
That's
awesome.
Let's go to some of these rooms, guys. If y'all don't mind, help me host. Who wants to go to room 5? Jimmy, you want to take room 5?
Sure. Let's
Take
go.
room 5, and then Helen, you want to go to room 4? And then
Yeah.
I'll do room. We're in room 1 right now.
Okay. I was trying to see how can we stop the recording, but
Oh,
Yeah, only
Jonathan.
Jonathan can do it.
Yeah,
Or
it's all right.
Sergio can.
We'll snip it.
maybe we can call
Yeah,
him.
it's okay. It's all right. We'll just snip it.
Okay.
So Jimmy 5, Helen, you can
4.
do, or if you want to go with yeah, go to 4, or go wherever McCartney is. He's only with 3 people. So if you want to go there, go to room 2. Helen.
Yeah, either way.
Yeah, do, and then I'll go to 3.
Okay.
All right. We'll see you
All
guys
right,
in a
guys.
little bit.
See you in a bit.
Okay.
You guys are always cutting me off mid-sentence, guys.
Oh man, we just got cut off.
Serge, I was just gonna tell you, I don't appreciate getting cut off mid-sentence.
Were you about to get deep? I'm sorry.
Yes?
I'm sorry. We'll do one more. Let's do one more, guys. How about that? Y'all ready?
Yeah.
Up for one more, McCartney. We good? All right. All right. Cool. Cool. All right. Here, let me see. Let's make it even. Jimmy, I don't know if you want to go with McCartney or how can I move him? Here, let's see where everybody's at right now. You're muted.
Oh, you can.
I can just join with them because we're the co-host, right?
Yeah, you can just join with them. Go ahead, Jimmy.
Okay.
Yeah, I already joined.
I wish I can throw him in room 5. How can I throw him in room 5?
Let's see. Oh, you can move it. I can move.
Yeah,
can
move
move
him,
him.
move him in room
Hey,
5. That's where
Sergio, you
everybody's
put
at.
us in the same breakout rooms, man.
That's an accident.
Oops.
Hey, Jimmy, you want to move him to room 5? The largest one?
McCartney's back.
I'm back. Put me in a room with new people.
All right, sorry about that.
We just moved you, man.
Yeah, we just moved you to. Where you at?
I'm
Oh,
over
he's in
there.
Room 5.
He's like, I'm over here. Yeah, just
Where
go
you
to
moving?
join that room.
Join 2? Room 2 again.
Join room 5.
Room 5.
Jimmy Lou has invited you to join room
Okay.
5. Okay.
There we go.
I just moved you. Okay, now he's good.
He's like, I don't like this.
He's like, where is he? I'm here.
Carlos, you look good, bro. Cut your hair.
Thank you, thank you. Yeah, I decided
I
to.
like your shirt, Carlos.
Yeah, I just thank you. I decided to cut my hair and get a fresh shave. You know, it's funny. I go through these cycles where the majority of my cases are with judges, and they don't mind the long hair. And then I get every once in a while, you got to look at like court decorum. And there was a judge that says if you're a guy practicing in his court and a guy attorney, you have to have short hair. He does not like long-haired attorneys.
No way.
Beards, no beards. Yeah.
That's why I don't get into law.
Jimmy's like, that's why I'm a real estate investor.
Yeah, I mean, I like it though. I get to do a lot of like cool things. I was telling Sergio, I was texting him this morning, I've moved from doing real estate into doing real estate law, and that's my main focus now, but I still do a little bit of real estate, and I get some like really weird stuff. Like today I got appointed. Another attorney friend of mine was like, hey, I need to sell this house. No one wants to buy it. I can't move it. I don't know anything about real estate. So I was like, you know what? Yeah, I'll go look at it. I showed up and I called Serge about like 30 minutes later, and I was like, bro, I have this house. I need this shit gone. It was definitely an investor special, but some days I'll be looking at like, $1 million homes. Other days it'll be, hey, the court can't sell this house. I wonder why. And you show up and it's just like studs pretty much. So my day's a little bit different every day. So yeah.
What's up?
Oh, looks like Ashley's in two
You
different
put us in
rooms.
the same room, Julio.
Oh no, it's because Ashley's on her phone, but I was on my iPad, so we
kept getting in the same rooms.
Oh, okay. Well, that's interesting.
Sorry. See, we got a room going right now, so we're good.
How many people are in here?
Okay.
Sergio, you know what was interesting? was when he was talking about the property management thing.
Yeah.
Because you know, like Grant Cardone has his own property management. I mean, the big
Yeah.
ones like that.
Okay, I live in Dallas, Texas.
So it's not
Oh,
wrong.
okay, nice.
Let me
Yeah.
mute these girls. It's not bad to have your own property management. Where it's bad is when your KP is your key principal, your sponsor, the person signing the debt is what he's saying is where there can be some kind of conflict of interest. Carlos, speak about this, bro. You had a case.
Yeah, I'll tell you guys briefly about my case, and the lessons I learned on it. I had a case where this guy, he was taking, kind of like I would say it's like one of these, multifamily groups, but it was this one guy, he's like, hey, I do real estate, let me get some friends together and start investing. And he was kind of double dipping to where he had, he would gather 10 friends, 15 friends, whatever the number was. And he would buy these properties and he'd be like, oh, you know what? We're buying them. I'll put them under my management company. Don't worry, just invest the money. And, I'll send you guys an invoice for whatever my management company does. And in the contract, he had that all work on the properties had to go through his company. They had to be done by his man, plumbing, electrical, rentals for washers and dryers all had to go through his property management company. Sorry if you guys hear some background noise. So all this stuff had to go through his company. And at the end of the day, I mean, he was charging these, his investors, partners, thousands upon thousands of dollars a year for, basic stuff. Lawn maintenance was coming out to like $4,000, for 2 properties a month. And it's not large properties. And he was charging them, $100 for a washer and dryer rental. And, the market rate was like $50. So he was taking a little bit off the top, and over time, he knew like, hey, I have this exclusive contract, let me hike the rates. And so when that happens, yes, it's in the contract, but at one point, when does it amount to stealing? When does it amount to, kind of taking advantage of a situation? And yeah, and sometimes it's all right to kind of, double dip, say, hey, you know what, I'm going to, manage this property, I'm going to be an investor in it, but it all has to be within reason, right? Like, you're never going to be seen as the bad person if you do it within reason. If it's, market rate, you're fine. But at the point where it's becomes a monopoly and you're not able to, diversify or get quotes from other people, it's really crossing a boundary on what your fiduciary duty is as a, just as a property manager, as a manager on a deal in whole. Your duty is to the investors, your duty is to the partners, the people that are paying you to do this. And, in that case, this guy, the court found him guilty. I mean, he had stolen over the course of, I think he was stealing around 50 grand a year from these people. Yeah, so it amounts to a lot. And, a lot of times, I think that's one of the reasons I stressed it in my call was, even if you're a passive investor, you got to look at the books. You got to take an active role. Like, being passive does not mean be passive. You got to take an active role, question everything, okay, why did this bill come out to this much? Can we get it lower? That all eats at your margins. And unfortunately, that's something that these investors didn't do. They just trusted too much.
And man, that was great, Carlos. And I think something that we do, guys, we try the cash flow empire, right? We have deals. Most of you guys have invested. Some of you guys have invested. I know Irma's one of our investors. There's obviously trust there. Mel, we're working on Melissa. Yoshiro is one of our investors. But what we try to do is create educated investors so that you know what to ask, not only with us, but for other operators. So you come educated. So some of the things that we do is we send out the rent rolls. We'll be sending out rent rolls. We'll be sending out T12s, so that, like Carlos, to Carlos' point, well, what's this? What's that? You can ask your general partner these questions. You know what I'm saying? This is why we do all this, you know, and for the bigger picture, this is why we do this. Because we invested in deals where we were uneducated, guys. We don't want you guys going out in the world of multifamily or even investing in general without sticking your chest out and saying, you know what, you're taking $50,000, $75,000 of my hard-earned money. Yeah, you bet your ass I want to know what the fuck's going on. You know, you bet your ass that I know I'm going to ask this question. Well, how many cycles have you done? How many deals are you a part of? How much money have you raised? Who's the sponsor? Can I see the T12? Can I see the rental? Send me the financials. I want to take a look at it. They tell you no, red flag. You don't want to show me the underwriting? Why not? I'm your investor. You're telling me I'm going to make 8%, 6% annually. Where can I see that on the underwriting? Red flag. They don't want to send it to you. You have more than any right to sit there and ask for this information. Do not forget that. At the end of the day, it's your hard-earned money. So be smart. Invest with people that you can trust. Don't be scared. You know, just do your due diligence, as we talk about it every single Tuesday night from the different speakers that we bring. We are here to literally educate all you guys to be savvy investors, so that when and it doesn't even have to be our deal, guys. It can be anybody else's that you see from MFM. It can be any other group, Grant Cardone, Brad Sumrod, Rod Cleve, whatever it is. Think multifamily. You at least know what questions to ask. You know how to vet these individuals, because there is a lot of snakes out there, and you got to watch out. You got to watch out. So Carlos, we're actually going to have Carlos back soon. We had a good first run, and I mean, talking about cases like this is what helps out a lot of individuals. Now I'm going to start asking that. Okay, the KP wants to be the property manager. I might think twice about that now because of what we learned today. You know what I'm saying? So there is a lot of KPs/sponsors that are not active in deals. They just signed a debt. They're trustworthy. They're able to secure the Fannie Mae's and Freddie Mac's. So that's usually why you use a KP. I haven't ran into this situation where a KP is trying to be the property manager, but I promise you, I will start asking questions when we come across that, because that was gold right there. But that was my little going off spree. We will have Carlos again, like I said. I think we had a lot of fun. He was a little shy, though. He was a little shy, but we'll get him on the next one.
Yeah, and I mean, guys, I think I really stressed this in my call if you missed it. I put my information down there. It has my personal cell phone number. I know a lot of people, especially a lot of attorney friends I have, they're like, man, why do you give people your number? Don't give out don't give clients your personal cell phone. Have them call the office. I don't take that approach. I really like to connect with people, and I'm not going to charge you for, a 15-minute phone call when you're like, hey, can I just ask you this, question? I mean, if it amounts to legal advice, then it's kind of like a gray area whether I can tell you or not. But if it's something you're like, hey, can I ask you on this advice? Like, I don't know what to do with this. What would you do? I don't mind, talking to you guys. This is why I became an attorney. And, like Sergio said, this is why I still come back to these calls, is because I hate seeing people get taken advantage of. And I see it all the time. People don't call me when things are going right. They call me when things are going wrong. And I don't want that for you guys. I want you guys to be able to say, you know what? I know what I need to do because I came here. I saw this podcast. I learned this on the Cash Flow Empire. So that way you become a savvy investor. You learn and you know what's going to happen.
I love it, man. Thanks for coming, bro. Carlos, very busy. He texted me earlier. Hey, bro, I try to always make it out to your calls, but man, I'll be able to make it tonight. So for sure, brother. Hey, Ashley, if you want to get his number, Ashley does a lot of partnerships and flips and up there in McAllen.
Getting it right now.
Yeah, I'm like, what's this guy's
So
name?
they got some big things going on, Carlos. That
I just put it in the chat.
Thank you.
Yoshi, you're the best. She's killing it right here, backing me up. Jimmy too. But yeah, Jasmine and Ashley, I want to get his information. Because there's some moves that are going to be made up here in Dallas, Carlos, and we'll probably need you there too. But cool beans. Should I close the chat? I mean, we've been at it for a while. Let me close all
Cool
rooms and get everybody back in.
The coolest beans.
Oh my God.
Out of all the things you could have used, beans. You're so
I just-
racist, man.
Just do it.
Yo.
I can say it, I'm brown. I can
I'm
say
like
that.
I'm like a pinto bean. I'm like red. Yeah.
I'm a garbanzo
You
bean.
are. You're a celery stick.
That's right. I'm just kidding.
Oh my God. Jasmine, why didn't you come?
My cousin was in a car accident, so
Oh, that's right.
I needed to shoot over to Kingswood. So I was there Thursday through Sunday. Yeah, he's
Next
got
time,
a rough.
though, we had a good time, though. We had a lot of fun.
I heard. I was like, no.
It was like a never-ending day, right? It was
Yeah.
like the longest Friday of my life in a good way. I was like, man, this is just kept going and going.
Man, we went for like 12, 15 hours, man. It was, no,
Yeah.
man.
Oh, I love that. I'm so glad you guys got a lot of y'all covered a lot of areas. I know that you guys were able to talk some stuff out, so that's really exciting.
Yeah. I think we need to get into deeper conversations. We were pretty lit when we were talking, but
Yeah, we were. But it was good.
yeah, we'll get together. I think Jonathan likes it, and as long as Jonathan likes it, then I love it. Obviously, he's my partner, and so we'll see what we can do there.
Yeah,
Well,
and I would
Jonathan
love
here?
Awesome.
I thought he was in the party.
Where'd he go? Oh, there he is. McCartney, man, what'd you think about this?
It's an interesting format. It made it simple, and I've got 2 dogs that are starving that want me to feed them.
Awesome,
And
brother.
they're
Hey,
being very quiet.
we'll go ahead and wrap this one up. Guys, once again, McCartney, thank you for hanging out with us tonight. I think it was a great turnout. I personally learned so much information. My brain was like, phew. So yeah, I think it was amazing. Once again, everybody, McCartney, hey, thank you so much, brother.
No problem. I appreciate it. I got to go feed the dogs.
Yes, sir. We'll see you later. Thank you.
See you next year.
Yes, sir. Next
Oh my
year.
God. No, I don't know why he said that.
Why do you say next year?
Because he says that he does the analysis twice a year, and he told me that.
So we caught him right on time. That's good.
Yeah, he said the
Yeah.
next one's in January, right?
All right,
Oh,
we're gonna
shit.
book him for
Something
January.
like that.
We'll book him in January. We'll compare his. I'm gonna pull up this recording and be like, "Hey, bro, you're fucking lying." Nah,
I don't think so. That dude is smart, then.
It's
Nah,
all a
dude.
guess. It's all
Yeah.
a guess. That's the thing about
Yes,
it.
sir.
it is. It is. It's a guess, and
All a
to
guess.
kind of like sit there and say, "Was my analysis right?"
Yeah.
But that's the shit we need to know, guys. Like
Well,
this is what we need to know.
He usually do it here in Austin. So in Austin, there is a big meeting on Tuesdays at noon.
I think
And-
Sarah went there.
I'm sorry?
I think Sarah, she participated
yeah.
in that meeting.
I actually
Yeah.
met Helen there.
Nice.
Yes,
okay.
yes. And Brenda also goes there here in Austin. And well, they said that McCartney do that before COVID, like maybe 2 weeks before COVID. And he said to the people like, okay, looks like this is going to happen. This is the data, what is showing. I'm going to my house and bye-bye. And then 2 weeks after that, COVID happened and everything shut down.
Dang,
Yeah.
that's crazy. That guy's like a genie, man.
Yes,
kinda-
people. Yeah, they said, I don't know because I was not there. I was not here in Austin when that happened, but people said that when he said that, people didn't trust him, and the people was kind of like, no, just continue with your life, and then that happened, and like, okay, now I think that's why also in this meeting that happened in Austin, because he did this presentation here in Austin, the room was super packed. I think because he has been having a track record, like his history doing this, and looks like it's going good.
Nah, it's good. It's good to know this stuff. This is the stuff that this is the nerdy stuff that nobody looks
It
at.
is.
Like,
Yeah.
you know, and you need to know this. Like, I need to be able to tell my investors, look, we're at a downfall right now. now is the time to invest. What do you say till he didn't say till March, right? Or till November?
He says that it's dependent on the interest rates, interest rate cap rates.
Yeah.
The peaks and plateaus that are in the pictures. But we can see a record again.
We'll see the record again.
Did anybody ask about, who talks to him? Can you send him a text? Okay. Ask him about the valley, because he didn't count it because it's Mexico on the map, so you just cut it off at that little area.
It looked good down there. It was green.
I couldn't see it, literally like a Corpus, and then it was just cut off the whole map because it's Mexico, I guess.
Valley. Ask him about the valley, but let me see. Awesome, but
So
I
that's
guess
why they do it every 6 months, because they're predictions. And so then sometimes, like, I've listened to some and they come back and it's like, oh, well, my prediction was a little bit off, or I was right on target, like you said. with
Yeah,
COVID.
for sure.
But yeah, he's
we'll have
good.
him back on. We'll have him back on for sure. But it was an amazing call. And Ashley, we'll let you know about that, what he says about the valley. I don't know if he's going to reply really fast right now, but just let us know, Helen. But guys, amazing call. Thank you for coming once again. I mean, we're the last 20 that stayed here, rolling deep.
Hey, where is the birthday guy? Where is the birthday boy?
The birthday boy is at a birthday dinner.
Oh.
Yeah.
So
Happy
he's with
birthday, Mr. Jonathan.
He's with his better half at dinner, and I told him, take the day off. I will handle the call tonight.
You handled it well, Sergio. Good job.
Hey, it was fun.
Yeah, you did good, Jonathan. Sergio.
Yeah, it was great, guys. Thank you so much. And everybody that keeps coming every Tuesday, thank you. We'll have more speakers, and we'll keep growing and have even bigger operators. And I mean, we have some big things coming. So keep tuning in, guys, and we'll see you later.
Hey.
Thanks once again,
Thank
guys.
you. Have a good night.
Thanks,
have a good
Sergio.
night.
Thank you, guys. Take care.
Bye. Good night.
Bye.
Good meeting everyone. It's my first one, so
Hey, bro, keep coming. Keep coming.
Congratulations.
will do. Thanks.
Every Tuesday at 7 p.m. If you signed up, you should get to know next week.
Nice. Are you guys a part of MF Mindset?
So we have a couple of people. We're basically a part of like a mixture of Grant Cardone and Brad Sumrock.
Okay.
But a lot of MFM people come here. I don't know.
Yeah.
I'm assuming who did, how'd you hear about us?
Austin.
Austin, hell yeah.
Yeah.
Yeah. Austin's a good dude, man. So he
So,
comes, he shows a lot of love. He's actually a part of our mentorship.
Nice.
So we just try to give people that extra, boost so that because I know how it is. I don't know if you pay the 40K, but Mr. Willie right here down here. I don't know if you see Willie down here. Willie's also a part of MFM.
Okay.
And then Kevin McQueen's MFM, Yoshi's MFM. She was the one on the chat going crazy.
Yeah.
Austin's MFM. There's a handful of MFMers that I recruited just because I just advise them, hey man, I need to kind of diversify a little bit. Go see what's out there, go meet more people, more networking is always good.
Right.
So man, keep coming, bro. Keep coming.
No, definitely will.
If you have any questions, Austin's got my number on speed dial, man. If you have any questions or anything you need, man, give him a holler and we'll set something up, bro.
For sure. Sounds good.
So,
I appreciate
brother,
you guys
keep
having
coming,
me.
man.
It's a
Thanks
great
for coming.
interview.
Thank you.
All right. Have a good night.
Yeah.